Today's focus is Bitcoin swing trading. $60,000 was the level that mattered. We knew if that structural low was broken, it triggered a major market structural change. Let's explain why. The structure is telling us that Bitcoin has further downside that every trader should be watching. We'll reveal that zone shortly. But first, let's examine the clues, because Bitcoin was warning us this decline was coming long before the breakdown actually happened. For 20 years trading and investing, we continued to manually plot weekly and monthly swings as the most effective way to understand any market. Here is the monthly chart. Notice before the trend was undecided, but now breaking the $60,000 structural low means the monthly is in a confirmed downtrend. This is crystal clear on the weekly swing chart, a clear continued move down. If we now add the daily chart, what do we see? A clear directional move lower. In less than a minute, we already understand market context. Monthly downtrend, weekly downtrend, daily downtrend. All higher time frames are aligned, and we have not done what the majority of traders do and dive straight into the bar-by-bar activity. The value is simple. Fighting the trend is expensive. Trading with it puts the probabilities on your side. Now let's put some time and price on the chart because this is where Bitcoin started leaving clues. The first clue was position. Bitcoin was trading below the 2026 midpoint shown by the purple dotted line. At the same time, Bitcoin remained trapped inside the February range, which has dominated price action for much of 2026. We briefly broke higher in May. Many traders interpreted that as strength, but the breakout from the February range failed right at the yearly midpoint. This is a strong signal. When a market makes new highs, fails to follow through, and then produces a lower high on the daily chart, it gives us a strong clue as to direction. And remember, monthly downtrend, weekly downtrend, daily downtrend. 3 time frames all pointing in the same direction. That's not a prediction, that's evidence. If the May high breaks, the bearish case weakens. If price continues lower, the downtrend remains intact. If you enjoy this style of Fibonacci and swing trading analysis, subscribe to our channel, and we also produce a newsletter, link in description. Now let's add a few more pieces of evidence. The first is the Ichimoku chart, which produced a TK cross around the 23rd May. Ichimoku traders know this as a bearish signal. On its own, it's not a strong signal, but combine it with our higher time frame down bias, and the evidence was beginning to stack up. Then we added the 2026 anchored VWAP. Very few traders use this tool, but we find it extremely useful because it helps identify institutional volume price levels. At the end of May, Bitcoin was sitting directly on the 2026 anchored VWAP. When June arrived and price immediately broke below it, bearish sentiment was being confirmed. Swing market structure on all higher time frames was weak. A failed breakout at the yearly 2026 midpoint, a confirmed bearish TK cross, price action breaking below the anchored VWAP. The case for lower prices was compending before the decline accelerated. But none of that tells us where Bitcoin could find support next. For that, we need Fibonacci. Fibonacci is the cornerstone of our trading once we have first identified swing structure and then confirmed it with price and volume. Here is what our Fibonacci zones are telling us. We have already broken our previous Fibonacci support zone between 63,317 and 63,714. But notice what is happening now. Price is retesting the underside of it. This often happens following a break, and what happens here decides the next move, because simply breaking a zone does not automatically invalidate it if buyers can quickly reclaim it. However, additional closes below the zone confirm it has been violated and should eventually be removed. For now, we'll keep the Fibonacci zone on the chart, knowing it has already been breached. The next Fibonacci support zone sits between 53,654 and 54,004. In other words, the market structure is now suggesting a possible test of the psychological 55,000 level. The Fibonacci resistance zone overhead sits between 78,380 and 78,390, which was formed from the May decline. Now that Bitcoin has broken the 6th February structural low at $60,000, we have no meaningful price support structure beneath the current price and a market structure that remains bearish across all higher timeframes. We also need to put this decline into perspective. Capital constantly moves between markets. Right now, AI continues attracting enormous speculative interest, and when investors need liquidity, crypto is often one of the first places they look. That doesn't change Bitcoin's long-term future, but it can create additional selling pressure in the short term. Should price move to our next Fibonacci support zone, we'll reassess whether buyers are prepared to defend it or whether the zone also fails. Hope today's analysis has been informative to you, and don't forget to subscribe to our channel where we produce daily crypto trading analysis. Thanks for watching.